Prologis Q2 2026 is officially out. They absolutely crushed consensus today. Net earnings per diluted share hit $1.13, which is just a massive jump from the 61 cents they posted in Q2 of last year.
Yeah, that is a huge beat.
Right. And core FFO, funds from operations, came in at $1.63 per share. That's up from $1.46 year over year. Total revenues hit $2.425 billion.
Incredible top-line growth.
And the market is reacting. The stock popped about 4% in pre-market trading, mostly because immediately after those numbers, management raised their 2026 guidance.
Again?
Yes, for the second time this year. Net earnings are now projected at 4.4 to 4.55, and they bumped core FFO up to 6.22 to 6.3.
I mean, seeing a second guidance raise in a single calendar year from a company of this sheer size, that is the real story here for you as an investor.
It really is.
When a logistics giant with, billions in revenue adjusts their forward-looking numbers upward yet again, it signals tremendous underlying momentum.
Yeah, they aren't just like coasting on macro tailwinds here.
Not at all. They are actively capturing upside in a way that basically proves their internal visibility into the market is incredibly clear right now.
So in this deep dive, we are tearing into the mechanics behind those exact numbers. We're looking at how the ultimate cardboard box landlord is quietly plotting a massive shift in their business model.
A very surprising shift, honestly.
Totally. And our mission today is to figure out if this new strategy is a stroke of genius or if it introduces a massive execution risk for anyone holding the stock.
Right.
Let's start with the momentum behind this top-line beat, because revenue doesn't just materialize out of thin air. You have to look at the operational metrics.
And their operational metrics were staggering this quarter.
Seriously. They signed a record-breaking 67 million square feet of leases in Q2 alone.
Which is just a massive footprint.
To put that in perspective for you, that is well over 1,000 NFL football fields of industrial space, either changing hands or rolling over in a 90-day window.
Wow. Yeah, when you frame it like that, the scale is hard to comprehend.
And their owned and managed period-end occupancy actually ticked up 20 basis points. They're sitting at 95.5%.
Which is wild. And you have to look at that 95.5% occupancy rate right alongside their cash same-store NOI growth, which came in at 8.5%.
Right, same-store net operating income.
Exactly. It simply measures the cash generated from the buildings they already owned last year. So without adding new buildings to the equation, the actual cash spun off from their existing footprint jumped nearly 9%.
That is a massive yield jump on the exact same dirt.
Yep. They're squeezing significantly more yield out of the exact same property.
But okay, here's where I want to push back on that a bit. And frankly, it leads to the numbers that really jumped off the page for me.
Okay, let's hear it.
If a hotel is 95.5% full, it's essentially sold out. You can't just squeeze more guests into the lobby.
No, you can't.
So if Prologis is sitting at 95.5% occupancy, aren't they basically hitting a growth ceiling regarding their physical footprint?
I see where you're going with this.
But then I look at their rent spreads, right? The net effective rent change was a staggering 36.9%.
Yeah.
Cash rent change was 22.3%. And yet, their customer retention somehow remained strong at 72.7%. So I guess my question is, how are they essentially sold out, hiking rents by almost 40%, and still keeping nearly 3/4 of their tenants?
So the hotel analogy is intuitive, but it doesn't really map to commercial real estate mechanics, and understanding why is super crucial for you as an investor listening to this.
Okay, break it down for us.
Think of it less like a hotel where the price changes every single night, and more like a massive apartment building where everyone signed 10-year leases back in 2016. The landlord isn't looking for new tenants to fill empty rooms. They're simply waiting for those old 2016 leases to expire so they can finally charge 2026 prices.
Got it. So this is the mark-to-market dynamic playing out in real time.
Exactly. The real growth engine for Prologis right now isn't finding new, undeveloped speculator rent. The immediate engine is what the CFO explicitly called their embedded rent growth.
Embedded rent growth. I love that.
Right. They are rolling over these older, cheaper leases that were signed 5, 7, maybe even 10 years ago. When a tenant's lease expires, Prologis isn't just renewing it with a standard 3% inflation bump.
Right. They're jacking it way up.
They are bringing those old contracts entirely up to today's significantly higher market rates. They capture that 36.9% spread on the net effective rent just by doing paperwork on the space they already leased out.
The fascinating part to me is how inelastic their product actually is. I mean, think about it. If literally any other business raised prices by 36% overnight, you would expect a mass exodus of customers.
No, totally. People would riot.
But a 72.7% retention rate means nearly three-quarters of their customers are staring at these massive rent hikes and saying, yeah, we will pay it.
Because they have to. It proves that the locations Prologis holds are absolutely mission critical.
Right.
If you are a major retailer, you simply cannot afford to move your logistics hub 30 miles further away from the urban core just to save a few bucks on warehouse rent.
Because the transportation costs would eat you alive, right?
Exactly. Rent is typically only about 5% of a supply chain's total operating cost.
Wow, only 5%.
Yeah. Transportation, so the fuel, the trucks, the drivers, that makes up closer to 50%. So if a tenant moved to a cheaper remote warehouse, the extra transportation costs to get their goods into the city will completely wipe out any savings they got on rent.
So this is the ultimate test of pricing power. Prologis owns the strategic real estate closest to the end consumer, and the tenants are basically trapped in a good way.
Yep. That cash same-store NOI growth of 8.5% is the direct mathematical result of that embedded rent growth flowing through to the bottom line. It's highly visible, highly predictable earnings growth that doesn't require laying a single new brick.
Okay, so if your occupancy is pegged at 95.5% and you're squeezing 36% rent hikes out of your existing footprint, eventually you do hit a physical limit on your current dirt. The cash is piling up from this embedded rent growth, which forces them to look outward. You either have to buy or you have to build.
Right.
And that shifts us perfectly into their aggressive capital deployment numbers for Q2. They dropped $1.119 billion in acquisitions this quarter.
A very busy quarter for the acquisitions team.
But wait, the stabilized cap rate on those acquisitions was 4.1%. I actually have to push back here.
Okay, let's hear it.
In this higher for longer interest rate environment where you can get close to that yield on literally risk-free government treasuries, why deploy over $1 billion at a 4.1% yield? Help me understand the math there because it feels a little low.
It does sound counterintuitive on the surface, I'll give you that. But you have to look at two critical factors management highlighted on the call.
Okay.
First, these assets were purchased at attractive discounts to replacement cost.
Meaning what exactly?
Meaning Prologis bought these existing buildings for less money than it would cost to buy the land, buy the steel, and pour the concrete to build them from scratch today.
Ah, so they are getting them on sale.
Basically, yeah. And second, a treasury yield is fixed, right? The 4.1% cap rate on these White Houses is just the starting point.
Well, because of the rent growth.
Exactly. Because of those rent escalators and the embedded rent growth we just talked about, that yield will compound and grow year over year.
So they are locking in the asset below replacement cost and banking on the yield growing past the risk-free rate relatively quickly.
Spot on. And alongside those acquisitions, they initiated $1.342 billion in development starts.
Yeah, and this is where we see the transition in their strategy. This is the pivot that I think requires some serious dissection.
Oh, absolutely.
Because CEO Dan Leder made a statement that should completely reframe how you look at this stock. He basically said Prologis is entering its next phase of growth where logistics, digital infrastructure, and energy all intersect.
Such a powerful quote.
And to back that up, they expanded their data center power pipeline to a massive 5.8 gigawatts.
Yeah.
I have to admit, this is a jarring shift in strategy.
It is a massive pivot.
Prologis has historically been the ultimate cardboard box landlord. They provide physical, unglamorous warehouses for B2B and retail fulfillment. Now they suddenly want to be the landlord for the cloud.
Yeah, it sounds a bit out of left field.
Why does a warehouse REIT suddenly think it has a competitive edge in data centers and energy production?
It sounds like a massive leap, but when you actually look at the mechanics of digital infrastructure, it makes perfect strategic sense for them.
How so?
Think about what a tech company actually needs to build a massive data center today. They face three primary constraints.
Okay.
They need massive clots of industrial-zoned land. They need that land to be in really close proximity to major population hubs to reduce fiber latency. And, most importantly, they need staggering, almost incomprehensible amounts of power.
Right, because data centers are basically giant power vacuums.
Exactly. A bigawatt, just 1 gigawatt, is roughly enough electricity to power a medium-sized city, and Prologis has a pipeline of 5.8 of them.
So the ideal footprint for a data center is basically the exact same footprint as a last-mile fulfillment warehouse, just filled with server racks and cooling systems instead of like forklifts and loading docks.
You nailed it. And Prologis already controls these assets at scale. They own the real estate in the exact high-barrier, high-growth urban markets that hyperscalers are desperate to be in.
By hyperscalers, you mean the Amazons, Microsofts, and Googles of the world.
Right. And that 5.8 gigawatt power pipeline is their real differentiator here. Securing grid power is the ultimate bottleneck for digital infrastructure right now.
Because you can't just plug a massive data center into a standard wall outlet.
No, you need heavy transmission lines, dedicated substations. The process of negotiating with utilities and municipalities to secure that kind of power takes literally years.
Wow.
So by pivoting to utilize their existing strategically located land bank to secure data center power rights, they are unlocking an entirely new, incredibly high-margin revenue stream.
That drastically diversifies the company for you as an investor. If you own this stock, you are moving beyond being purely reliant on traditional retail and e-commerce supply chains.
Yeah, it is a structural upgrade to their entire portfolio. The yields on data center developments are exceptionally attractive, especially when you already own the underlying dirt at a historical cost basis from years ago.
So it basically allows them to monetize their land bank at tech infrastructure valuations rather than traditional boring warehouse valuations.
Exactly.
But pivoting into digital infrastructure and starting $1.3 billion in new developments in a single quarter that requires serious capital and flawless execution.
It definitely isn't cheap.
Let's look at the financial foundation supporting this aggressive shift. We really need to evaluate the balance sheet health, the margins, and frankly, the major risks of trying to pull this off.
Let's do it.
So total available liquidity sits at a very comfortable $7.6 billion.
Which is a massive war chest. And their leverage remains very healthy, too. Debt to adjusted EBITDA is sitting at 4.7x.
That seems pretty low for a REIT doing this much building.
It is. For a real estate investment trust, undergoing this level of capital deployment and strategic pivoting, staying comfortably under 5 times leverage is a very strong signal of disciplined balance sheet management.
They aren't overextending themselves to fund this growth.
Not at all.
Total debt is high, sitting at roughly $40.4 billion. But here is the statistic that completely insulates them. The weighted average interest rate on that massive debt pile is just 3.3%, and the weighted average term stretches out 7.9 years.
Beautiful.
I look at that and it reminds me of a savvy homeowner who miraculously locked in a 30-year fixed mortgage at 3% back in 2021 before the Fed started hiking rates.
Yep.
Now they're just sitting back, making their cheap monthly payments, watching every other prospective buyer scramble to afford 7% rates.
It's the perfect analogy. In a higher-for-longer interest rate environment, having $40 billion locked in at 3.3% for nearly 8 years is a massive competitive moat.
A huge moat.
Their cost of capital is fundamentally detached from the current macroeconomic stress. It allows them to continue aggressively acquiring assets and funding these multi-billion-dollar data center developments, while their competitors are just completely sidelined by exorbitant financing costs.
We also saw some really savvy capital recycling this quarter. They generated over $1 billion from dispositions and contributions to their strategic capital vehicles.
Yeah, they managed that capital beautifully.
For those of you wondering what a strategic capital vehicle is, Prologis essentially operates a massive private asset management business on the side.
Right. They manage private funds for institutional investors.
Exactly. So they can actually take a warehouse they own, sell it into one of their own managed private funds to raise cash instantly, and then still collect management fees for running the building.
It's an incredibly efficient way to prune the portfolio.
It really frees up capital to fund these higher return data center opportunities without taking on new expensive debt.
And the return profile on those new opportunities is widening significantly, which completely justifies the recycling.
Let's talk about those development margins because they are crazy.
Yeah, take a close look at this. The new development starts, they announced boast an estimated weighted average margin of 32.3%.
32%.
Compare that to the 13.8% estimated margin they are seeing on their recent stabilizations, which are their recently completed projects.
Going from a 14% margin to a 32% margin on new dirt is a massive jump in profitability.
It directly reflects the mix shift toward digital infrastructure.
How so?
Well, when you were delivering a fully entitled, power-ready site for a tech giant, The premium pricing you can command heavily inflates those development margins compared to just, handing over an empty warehouse to a logistics company.
Look, I have to demand the bear case
Yeah, I
here.
was waiting for this.
With the balance sheet looking this bulletproof, the embedded rent growth driving massive cash flow, and development margins expanding past 30%, where is the execution risk?
Nothing is perfect.
Right. Things in the market are never this perfect in perpetuity. If I'm an analyst looking for the cracks in the foundation of this strategy, where am I looking?
The primary risk you have to watch out for is undoubtedly the execution on this specific digital pivot.
The data centers.
Yes. Maintaining that 32.3% development margin relies entirely on successfully navigating the highly complex, regulatory-heavy data center and power grid market.
Right, because this is a very different game than pouring concrete slabs and erecting tilt-up walls for a logistics warehouse.
It requires a completely different core competency. You are dealing with regional utility providers who are already stretched super thin. You are dealing with highly specialized cooling engineering, intricate fiber optic routing, and increasingly stringent municipal and environmental regulations regarding massive power consumption.
It sounds like a logistical nightmare compared to a standard warehouse.
It is. If there is a delay in securing a critical electrical substation, or if they miscalculate the cooling requirements and power draw for a tenant, those 30+% margins compress rapidly.
So they are entering a space where the technical execution risk is magnitudes higher than anything they faced as a traditional warehouse operator.
Absolutely.
Let's talk about macro risks for a second.
Mm-hmm.
Prologis operates in 20 countries. Are they exposed to severe currency fluctuations? Usually, a strong U.S. dollar eats into the international earnings of a global REIT.
You would definitely expect a company with this kind of global footprint to be highly exposed to foreign exchange volatility, but management actually actively engineered that risk away.
Really?
They highlighted that their forecasted earnings for 2026, 2027, and 2028 are 99%, 98%, and 97% hedged or held in USD, respectively.
Oh, wow.
Furthermore, 96% of their total company equity is anchored in US dollars.
They are aggressively insulated from currency risks. They essentially bought insurance to take FX volatility completely off the table for the next 3 years.
Yep.
What this means for you, looking at the stock, is that any stumbles Prologis makes over the next 24 to 36 months will likely be purely operational, not macro-driven.
That is a huge distinction.
It is. If they miss on earnings down the line, it won't be because the euro weakened against the dollar or because interest rates spiked. It will be because they failed to deliver on that 5.8 gigawatt power pipeline.
Or because they mispriced the engineering costs of a major digital infrastructure development.
Exactly. The risk profile is entirely localized to their ability to execute this highly technical pivot.
Prologis is actively blurring the lines between an industrial warehouse REIT, a tech infrastructure play, and a localized utility company.
It really is a hybrid now.
It leaves you with a really forward-looking question to ponder as you evaluate your portfolio. If they successfully operationalize this massive 5.8 gigawatt power pipeline, and they prove they can reliably execute on these 32% development margins without stumbling over the technical hurdles, how will the broader market value this stock 5 years from now?
That is the multi-billion-dollar question. Will it still trade constrained by traditional industrial warehouse multiples? Or will Wall Street re-rate it, allowing it to command a massive premium as a digital infrastructure giant?
They are completely redefining what industrial real estate means in the digital age. The lines between logistics and data are just vanishing.
It is a fascinating transition to watch. Make sure you follow the show for daily, no-nonsense earnings coverage just like this. We break down the numbers and the strategy so you can understand exactly what is driving the market.